All right, this is our last set of value drivers. We've pretty much got everything. We know how to forecast sales, cost of revenue, but there's a number of things we don't need to forecast, right? If you go back to chapter 7, you'll see that you don't actually forecast gross profit. You forecast total revenue. Then you subtract your forecasted cost of revenue, and that gives you gross profit. Then you forecast selling, general, and administrative, depreciation, non-recurring. You subtract those from gross profit to get operating income or loss. Then you subtract interest expense to get income before tax. Then you subtract income tax expense to get net income. Then you calculate the amount of dividends that you paid, and you take the rest and you add it to retained earnings. So there are some items, like those that I've mentioned here, and like retained earnings down below, that aren't going to get a value driver. But what about something like cash? Well, cash is going to be our plug, so we don't give it a value driver. We don't give total operating current assets a value driver because we're going to forecast all of these items, add them together to get total operating current assets. We don't need a value driver for plant, property, and equipment at cost or accumulated depreciation because we're going to forecast the net plant, property, and equipment. And then we're going to add this year's depreciation expense to our accumulated depreciation and work backwards to get plant, property, and equipment at cost. Then down below on liabilities and equity, we don't need total current liabilities because we forecast accounts payable in the short-term portion of the debt and any other little ones that you have, right, that I don't. We add those together to get total current liabilities. We forecast long-term debt, other liabilities, deferred long-term liability charges, and then we hit this thing called minority interest. Minority interest, we're going to hold it constant. And to hold it constant, what that means is that you take the last year, your most recent year, 2012, or you may have 2013, or you may have 2014, depending on your company, and you take it and you allow it to be $11,624 every year in all of your forecasts. We're not going to try to forecast that as a percentage of sales because it's not actually going to work. It's not going to be meaningful, so we hold it constant. And if we add all this stuff up, we get total liabilities, so we don't need a value driver there. There's one more thing that we hold constant, and that's common stock, sometimes called paid-in capital. That's the amount of money that shareholders gave to the company in exchange for being owners the very first time or any time the company has sold stock directly to the public. So that number's fixed, and unless we have some specific information about this company planning to sell a certain amount of stock next year, we're going to assume that it stays the same. So we're going to hold it constant. We're going to hold minority interest constant. Retained earnings, we forecast by adding this year's addition to retained earnings. And then that leaves us with just the things we have to add up, right? So that's all of our value drivers. If you have an item somewhere in here that I haven't addressed, or if you're feeling confused about it, just email me and we can take a look at that. Occasionally something pops up that's unusual, but probably if you'll see something on here, you'll probably have an idea of how you might want to forecast it. And if you have an idea and you want to try something, just let me know and it's probably fine. Finance is a lot more creative than accounting. We're doing a lot of estimating, a lot of educated guessing. No answer that we come up with is going to be right. We'll have a right method and a wrong method, but the value driver that we choose isn't necessarily going to be right or wrong. So that's the rest of our value drivers. Let me know if you have any questions.